Should be able to run a program that lets the computer read it for us instead of me having to read it every time. Must be something like that. That is weird. Uh-oh. It's my mouse. Gotta be kidding me. What the shit's going on here? Here's my cursor. I can go back to Thinkorswim. Now my cursor works. But if I go back here, I lose my mouse. That's weird. Maybe on a different screen. Fortunately, it's a touch screen, so let's try that. Go over here. Whoop, the touch is working. Oh, and now I can use it. There's something wrong with this screen as far as the mouse goes, I guess. Nope, now it's working again. That's weird. Okay. Am I recording? Yes, thank you. It says recording. Or it says stop recording, so I assume if it says stop recording, it must be recording. Logic lesson 101. All right. Oh, no, this isn't what I wanted to do. Okay, sorry. I wanted to show you what we were just discussing in member chat at Phil Stockworld. So hang on. Here's today's post. And when we go below the line on today's post, where we had, so we start off with this NASDAQ chart, right? And what did we say this morning? This is with the 5% rule. For those of you who are not PSW members or who are new, you know, this chart is based on what we call the 5% rule. And it's not like something you can look up because we made it up, but we made it up and it works really well. And the 5% rule tells us, and well, it's a real quick thing. My dad and I used to, my dad used to design the computer systems that ultimately became trade bots that are used on Wall Street now. He was a really great computer programmer. And so back in the 80s and the 90s, we used to go, and I would, my father was like a really brilliant programmer, but he wasn't like a people person, so he had a partner, but sometimes I would go with him as well. And we'd sit down with the Wall Street guys, and I speak Wall Street really well. And I would sort of interpret what my dad was saying for them and what they were saying to my dad, and I would help sort of like organize the whole process of building these programs. So what I observed, because you know you go to pitch these things at all these different investment houses, like you're constantly going to different people who say, oh, what kind of systems do you design for us? Can you do this? Can you do that? And between going to these pitch meetings and hearing what they wanted from many, many different people, all confidential, of course, so you know I couldn't say this guy's doing that or that, but I could listen. And then observing the actual building of some of these, what I now call trade bots, which is just the program trading, the automatic program trading, that eventually evolved into high-frequency trading. So, unfortunately, my dad is kind of responsible for that. He built some of the basic backbone stuff that runs it today. But the concept was that everybody thinks they have their own system, but when push comes to shove, it starts out at a meeting. Then they say to do this, and they give you specs to do something, some sort of thing that does a program that does, you know, when it does this, we want it to do that. When it does this, we want it to do that. But as you go to 100 of these meetings, you start to realize that everybody essentially wants the same thing. They might think it's different, and it might look different on paper, but really it's the same thing. They want to buy at a certain point. They want to sell at a certain point. They want to have certain warnings in place. And when things pull back a certain amount, they want to pull the trigger and stop it. So when you have, if you go back and you study like Fibonacci retracements are things that occur in nature, and what it basically shows is that any sort of large random progression of growth in nature will at some point pull back and contract and then grow again, and then pull back and contract and grow again. That's just a natural phase of the growth, is a slight contraction process. So the short story is, though, that all these things are natural. And when you get a large enough group of people trading, which becomes the same as like nature. It's the same as having a billion flowers. You have a billion traders or a billion trade executions, and it starts acting like a natural phenomenon. So the growth grows and then contracts, and when the populations are in decline, they'll then expand and so on and so forth, and the same thing happens with the stocks. And the reason the 5% number, so the reason I came up with the 5% rule is because of computers and because everybody has a tendency to want to round things off. And when you start rounding everything off, instead of having the Fibonacci numbers, which are like 30, 20, I forget, they're like 22% or 24% or 36%, they're not quite 20 and 40. But the thing is that with computers and with everybody rounding off, and also people using random number generators, which aren't actually random. There's no such thing as an actually random number in a computer. It's just running a program that picks a number, but it's not really random. It seems random to a human, but it's not random. So with everybody using these things, they tend to converge on certain points, and those points those points, due to the human tendency to like round numbers and want to do things at round numbers, that then causes those conversion points to generally be round numbers. So the 5% rule is very much based on that and the behavior of these things over time. Okay, so that being said, these numbers are what we call the big chart. And, the big chart used to be just this. And then Jean-Luc started doing these, very, very nice illustrations to go with it, which is fantastic. Oh, by the way, Jean-Luc, if you're listening, we need to change the NASDAQ so that it reflects the NASDAQ. Where is NASDAQ? The NASDAQ 100. We're doing the composite here. If we had the 100, we'd be right in line. So if it's possible to change that to the 100, I'd appreciate it. So that's why it's so confusing to everybody where we are. And also it's more in line with the futures. Anyway, so, because originally I was thinking I was doing the futures when I charted these things out. And that's why we kept getting confused with the NASDAQ going up and up. But anywho, so these are our levels that we picked for the indexes to be at into the end of this year. And these were picked 2 years ago, not last year, but in early, I think late 2013 or something, we actually picked these. We haven't changed them since because my targets haven't changed since. And now Goldman Sachs just came out with targets that match this because Goldman Sachs doesn't think we're going any higher, not this year or next year. And I agree with them because there's been no real growth in profits and no growth in revenues, and the global situation hasn't improved that much. There's just no reason for this. So these are our numbers. So given that, those are our big lines. Those are our big 2-year lines. Within that, though, there's other lines. But using the 2-year line, we just so happened, so 2 years after we start charting this stuff, we hit the 4,400 line, which is a 10% line on the NASDAQ. Then we come back to the 4,000 line, which is our must-hold line on the NASDAQ. And of course, that's going to be bouncy. Okay, especially the first couple of times you test it. It's going to be very hard to break through. And if we look at the longer view version, oh, damn, that's the wrong one. Okay, hang on a second. Let me change this. Futures, indexes, right, NASDAQ. Okay, so if we look at the longer view version, weekly, let's say. Okay, so this is a close-up. Where'd it go? This is a close-up. This is the hourly, I think. Yeah, this is the hourly chart. And this is the weekly chart. Let's look at the daily chart. Okay. So on the daily chart, you can see we totally blew through. This is 10% line. We blew through the 10% line. And we got up to 4,700, which is almost a 20% up line from the 4,000 level on the NASDAQ. But that's okay. That's within the realm of realism. It's just a very enthusiastic run. But when you have a run that goes from the 4,000 line to the 4,800 line, okay, that's an 800-point run. Then the 5% rule says we're going to get retraces. And it's like I said, it's like a Fibonacci retrace, except our retraces are 20% of the run. Okay, we never actually hit this run, but how much is 20% of an 800-point run? That's 160 points, right? And what is 160 points off of 4,800? It's 4640. It's It's right frickin' there. Okay, that's what the 5% rule tells us is going to happen. When we break over, we had a little break, but it didn't hold. We have a retrace here, and we can do the math there, and this is exactly right too. Then we have a proper breakout, little consolidation, move up. We moved up to the 4,400 line, which is where we expected to consolidate further. Now we make an attempt at 4,800, but we stop at where the 4,800 retrace would be. Failing that, we move to the second retrace, which is another this is 4640 minus 160 is 4580, 4480. And you see this line here? Right about 4480. That's the second retrace line. Now, when that retrace line fails, boom, very, very bad. This is why we made all those warnings back here, because we saw this as a consolidation on the way down. And we had lots of discussion about that in August, about how I thought we were consolidating for a move down, not for a move up. So the 5% rule is all about, it's not just that you don't randomly pick lines, but you look for these great big consolidation lines. And let's go back to the weekly now. Okay, so let's look, see how that 4,000 line shapes up. It's a big consolidation line. This is an entire year, up and down around the 4,000 line. Okay, actually going almost more than a year up around that line. Also, though, of course, we started at the 2,000 line. So we knew 2,000 to 4,000 was a 100% move up. Okay, and a 20% retrace of that move brings you back to 3,600 right here. We had a very strong move up off 3,600, so it offered very good support, and that let us know we were going to go higher. And now we're down to here. All right? So we look at that. That's a very important thing. And, of course, all this stimulus is what did it, though. It's not natural. It's just because there was constant stimulus, so there was very little resistance to going up. Now the stimulus, here's the problem. If we spent, and we did, if we spent, I'm going to say we spent $5 trillion, let's say. The Fed went $3 trillion into, or more than $3 trillion. Let's say the Fed went $3 trillion into debt. Okay, doing this. They added to their balance sheet. It's not called debt by the Fed, but realistically, what do? They write a check. Here's how the Fed increases their balance sheet. They have, when they started, they had about $1 billion worth of assets here, right? And what they've done since is they take a checkbook, which has no money in it because they don't have a bank. They just take a checkbook, essentially, and they write a check, and they say, Citibank, would you like to get rid of $500 million worth of homes? We'll take those off your hands. They write a check for $500 million. They take $500 million worth of homes from Citibank, and now Citibank doesn't have to mark them down or do anything in their books. The Fed puts the homes on their balance sheet as if they were worth $500 million. Everyone's ignoring the fact that the housing market collapsed. And that's how the Fed just creates money, because they write this check. The check is good from the Federal Reserve. Citibank can use the cash and do stuff with it, and the Fed takes the asset. But they've really created money, because in reality, if Citibank had tried to liquidate those homes, they would have gotten $250 million tops for the homes at the time. Now, it's not a totally evil strategy, because in reality, it would have been devastating to them, and not just Citibank, of course, but it would have been devastating if all the banks had to write down all their bad assets at the bottom of the market, but they needed cash. So what the Fed did is the Fed says, okay, you know what? We don't have to worry about our balance sheet, because nobody checks, so we don't care. We don't have to worry about our balance sheet, so we're just going to write you a check for the full value of the assets that you want to get rid of. So all the banks dumped all their bad real estate assets and things on the Fed. And the Fed patiently, it's been 7 years now, has held this stuff on their balance sheet, and they haven't really unloaded much of it. Now, of the $4 billion something the Fed has written in checks, only $1 billion has been in assets, in hard assets like properties and stuff like that. But then the rest is like bonds that they take off people's hands, all the municipal bonds, the treasury bonds, all sorts of stuff like that. And the Fed, of course, has been buying all the treasury debt that we've been issuing for the last few years also. Now, that's there too, because the Fed's like the Fed's constantly at the auction saying, oh, we'll take those notes, and they keep the price of the treasury notes low as far as how much interest rates they're paying. artificially, because no other idiot besides the Fed would be loaning the government money for 10 years for 2%. But the Fed can do it because they're just creating the money out of thin air anyway. So, in summary, so the Fed has put $5 trillion into this thing. Our government has also done a few things to keep this stuff going. But, we have the TARP, obviously, but that was way back here. So, but, most of this stimulus is just Fed. It's a QE sort of easing coming in here. And so this costs roughly, let's say, $4 trillion to get to this level. All right? So to get 2,000 points on the S&P, on the NASDAQ, sorry, cost $4 trillion. Now that we're here, though, logically, if you want to get another 1,000 points, since we're now twice as high, if you want to get another 1,000 points, it's going to cost you double. So 1,000 points was $2 trillion. Now it'll cost you $4 trillion just to get to 5,000. That ain't going to happen. That's just not realistic. Okay, because first of all, people are getting tired of the money. Also, there's no repercussions from this. The Fed has this huge balance, and eventually they've got to unwind that balance. And when they unwind that balance, they're going to flood the market with unwanted properties and unwanted treasury bills and unwanted bond notes. They're going to just flood the market with crappy debt that nobody wants, and that's going to plunge the price. So that's going to cause a problem all by itself. So it's not so much the end of the easing, the end of the low rates that people are worried about. It's the unwinding of the Fed balance sheet, because they can't keep it where it is. And also, when they unwind their sheet, when the Fed takes losses, those losses reflect as negatives to our running balance sheet, to the running balance of the country. So in the Treasury budget, we have to write when the Fed loses $200 billion, we take a $200 billion hit on our deficit. So you can see how this gets really, really nasty. All right? We're in the end game here, folks. You can't, well, I think we're in the end game. A lot of people look to Japan and say there's no end game, because Japan, we're 100% of our GDP in debt. Japan is 250% of their GDP in debt. So Japan, and they're still going strong with their policies. Japan is running at a pace that's going to put them to 300% of their GDP in debt in like 5 years. It's insane. But again, this is where I start saying, and again, this is what happened here. Around here, I started saying this is way too much. I also started saying that you have to start looking at Japan, and I was more concerned about Japan than China, even though China was totally bullshit too, but that was beside the point. But I said you got to start looking at Japan, because you can't, at this point in Japan, even at the incredibly artificially low rates that their Fed keeps, the Bank of Japan, even at the incredibly artificially low rates that they keep, the government still is spending 1/3 of their tax revenue. So 1/3 of the government revenues that come in is used just to pay the interest on their debt. Not to pay off their debt, to pay their interest on their debt, and they're going more in debt every day. So, 1/3. This is why Abe is running around today, talking to every single TV station and everywhere that's going to listen, and he's telling people, we promise Japan will grow their GDP by 22%. And you know why? Because if they don't grow their GDP by 22% and take in 22% more revenues, their debt is unserviceable. And it's already starting to be questioned. All right, and I've been saying it's going to be questioned all year. Now it's starting to actually be questioned. Now comes the point in the crisis where the guy from Japan goes around telling you, don't worry, it's okay, which is the point at every crisis before a company goes bankrupt, where the head of the company goes out and says, don't worry, we're fine, like Glencore is doing today. We're fine. No big deal. So this is always what happens, and always is enough people, as P.T. Barnum says, you can fool some of the people all of the time. You can. All of the time, some of the people can be fooled. And all you need is some of the people to believe you, and boom, you're going to get a little bounce in whatever it is you're talking about. No matter how bad the company is, as long as somebody official comes out and says it, some of the people are going to believe it all the time, and they're going to buy it. Okay, the problem is you can't fool all the people all the time, and you can't even fool most of the people all the time, but you can fool some of them all the time. And that's always enough to make a bounce. And that's, again, it's essentially what Fibonacci says, right? You can fool some of the people all of the time. And those some of the people are where you get your retraces and where you get your bounces. No matter what the reality is, you're always going to find a certain amount of people who go the other way. And that works in nature and it works in finance. All right, so that's how we get to where we are now. So this morning, back to that. So it's very, very easy to say this morning that we know what our lines are. We know that we have a weak bounce line at 4080, and as long as that holds, we can stay a little bit bullish. We didn't get to our must-hold line yesterday, but that's good. When you do an air turn, it means you have such strong support down here at 4,000. Because not here, sorry, down here. You have such strong support at 4,000 that you can't even get to 4,000. That's how powerful the support is at 4,000. You can't even get down there to find out. Because already the first bounce, if you think of it like a little dome, right? You see that under the dome show? You think of it like a little dome protecting 4,000. Okay, so the first bounce line, the weak bounce line at 4080 is the dome protecting 4,000. So it comes down, it bangs into the dome, it gives a little bit, but then boing, and it goes right back up. In fact, it goes up with more force than it went down, right? That's more force coming up than down. Now it's consolidating, but where's the next line? It's got to get to 4160. It has, and that's what also in our 5% rule. We want to see strong bounces before we start getting bullish, really. We'll stop being bearish at the weak bounce line, which we did yesterday. When we got down here and it looked like it was holding yesterday afternoon, we cut out of some of our SQQQ shorts that we have in our in one of our portfolios. That's in our option opportunity portfolio. And in the short-term portfolio, we already flipped that TZA trade, so we already made that move. We do need in the short-term portfolio something much more aggressively bearish if these lines don't hold. So let's not forget that also. But anyway, so in other words, these lines are lines that we knew were going to happen 2 years ago. They don't change. We don't redraw them just because because this happens or that happens or this happens. No, we don't care. These are based on very hard numbers that are set up years in advance, okay? So, people ask me a lot, do we changing the lines or this, that? It's like, no, they don't change. They've been the same lines for a very, very long time. You can go back to posts from 2 years ago and see the same basic levels showing. We adjust them when there's a major breakout. Let's see. Can you see that on this? Yeah. So we were bullish here. So the end of 2013. So in 2013, this is what we projected would happen. We projected we'd get to 4,000. And we called that our must-hold line for a bullish rally. We said at 3,500 that we were in the bottom. Okay, in 3,500, if you look on this thingy. What thingy? This thing. Oh no, big chart. See 3,600? So when we were here, why is this so confusing? There, okay. So when we were here, we expected to break out over the 3,600 line. We got resistance, but we didn't know that here when we were doing it. We got resistance at 3,600. We pulled down a little bit, but not much, and then boom, off we go. So we predicted here that we were in the bottom of the new range. Okay, we broke out of the top of our old range, and then we reset our range, and we looked at it and made sure we checked all our facts, and we said here that we expected our new range was going to be a bottom over here at 3,600, and would top out at whatever the hell it topped out at. So it's 20% below, well, at 4,800, right? It would top out at 4,800 because 4,800, you got 20% down and 20% up is your range. This is the long end of the range. Realistically, though, 10% up, 4,400, and 10% down, 3,600, is where you kind of mostly expect to be. But the outliers are the 20% lines. The S&P went all the way to the 20% line. That's gone completely crazy. And, that's what I was going to show you also, right? So we looked at that later in the day, so I just drew those lines. All right, so you can see how easy it is to chart it, though, once you know how the numbers work. Now, the S&P, we just did that recently. Somewhere, didn't I? There it is, okay. So in chat, Batman asked me if we could do like the S&P where the bounces would be, and I said here it's the same thing. Don't forget, I don't draw these after the fact. These are just the rules. This is where it is. So 1850 on the same chart is our must-hold line, and that makes 1880 the weak bounce line. And look what happens at 1880. Look at that consolidation. All right, and at the time, I think I said something that we could short at 1880. Where did I say that? You know I said it somewhere. Political crap, let's see. Oh, well. I swear I said it. Oh, dear. All right, let's see. Oh, there. As you can see, the weak bounces are failing across the board, so 1880 on the ES is good shorting. So was it, in fact, good shorting? Let's go back to the indexes. Let's look at the S&P, and let's look at the 5-minute chart. And you can see that it was indeed, from whatever time that was, $12.12. Okay, so from $12.12, right here, I guess we must have been here, I don't know how it worked exactly, but from 12.12 when we were talking about it, 1880, oh, I know, because it's the problem was I didn't do the posting time, that's what happened, because I talked about that earlier on, and then I started adding a whole bunch of other charts, and that took time, so it was earlier when I said it, but unfortunately it was a little bit late by the time I printed it, sorry about that. But anyway, so right about here, 1880 was the very obvious, very good short line, big nice move down, 1870, you get below it, you take your money down, you take your money, as soon as you cross back over a 10 line like that, you take your money out and boom. And that's how you play the futures. And now you can see you have a downward channel. So it's very obvious that if this is failing here, you can short here, and then it's going to come down to here probably, and then you can, if it bounces back up, you can short there again. I prefer to do it with a bias. I don't like to play long, short, long, short. I prefer to say, I think we're going down, therefore I'm going to keep shorting, because I feel better about shorting than going long. All right, and then you see if we test that, then that'll probably give us a bigger bounce, but if we actually fail there, then we're probably going all the way back down to 1860 or so. But this is, it's not hard because then you just use these rules and you can see what's going on. What did I do? All right, so basically 1880 was a weak bounce, and there's nothing below that. There's no particularly good support until 1850. The 1860 line is support, but 18 is, it's only support just because it's been holding up. You see, this is the, you can see how it held up right here. It gave us some support, and also in the historical one, if we go daily, I think you'll see 1860 has been pretty good. Yeah, ignoring this little dip over here, we pretty much held the line back here at 1850, 1860. And I think we go longer, we might see something. So that's this. Oh yeah, and over here, that's where I got the impression 1860. And before this one that we just looked at, you have this one over here at 1860. So several times 1860 has been strongish support. So we want to see how that holds up. But basically below that, we start getting some real trouble. And we talked about that. If it was, and frankly, if it wasn't almost the end of the month, and they weren't trying to prop up the markets, I think we'd be in big trouble right now. I think you'd already be seeing it. Right? I think right now they're kind of propping up the markets as much as they can, so that people don't completely freak out into the end of the quarter. All right, let's see if there's any questions about any of this stuff. No, but everybody's so fascinated. There's no questions. That's fantastic. Alan says, do you like gold here, and what do you see over the next 3 to 6 months? I like gold because they keep printing more money. India today just eased their rates, more money. Anytime you hear easing, that means more money, basically. They're devaluing the currency more. There's more money being printed, put into circulation, whatever. So you have more money floating around, but the same amount of gold. It doesn't change the actual amount of gold in the world. In fact, this is fun because I can do visuals here. Okay, all the gold in the world. Here we go. Boom. I love Google. all the gold in the world. This is a picture of all the gold in the world. That's it. See that? That's a house. That's all the gold in the world, right there. There's another one with the Washington Monument. Oh, here you go. There you go. This is all the gold in the world. The Washington Monument, 18 stories high. The house thing is much bigger, much fatter than the Washington Monument. Here's all the gold in the world next to a pyramid. All the gold in the entire world is this. So people will tell you all kinds of bullshit about how much gold there is. And how, they'll say supply, this and demand that, and gold's not valuable, and gold's lost its luster, and they're freaking insane. Okay, here, more pictures. All the gold in the world. Can we make that bigger? New image. Okay, there, Statue of Liberty. It's not as big as the Statue of Liberty. All the gold in the world. Oh, this one's nice. Look, here's level one. This is how much of it is jewelry. This is how much of it is in private investment. 50% of the gold in the world is in jewelry. You can't get that back. I mean, you can, but it's hard. It's very hard to get. I mean, ask your wife how much jewelry she's willing to sell. All right, so it's not that easy to get the gold back that's in jewelry. And jewelry includes Donald Trump's gold-plated toilets and things like that. I mean, it's just any personal use of gold. So 84,000 tons is in jewelry. That only leaves this much. The world's governments, private people have 31,000 tons. Governments have 29,000 tons. And other people have 22, or other uses, whatever that means. Or maybe I get some computers and things like that. So other actual uses for gold, 23,000 tons. That's it. So when you think about it, it ain't that much gold. That means that the more money there is, what the hell? So the more money there is, the more the gold is worth, because you can't create more gold. I mean, yeah, they mine gold every year. I believe it's 2,500 tons. So out of 166,000 tons, that's about right, yeah. So let's see. Every year, going full blast, they mine 2,500 tons out of 166,500 tons is 1.5%. So every year, that's exactly right. Every year they create 1.5% more gold. That is not supply. So supply is never going to drop gold considerably. It will take them 10 years to add 15% to the gold supply. Now, what's more going to affect the gold supply is sometimes private investment will sell some gold, and what if they sell 10% of their gold? That's a whole year's worth of mining. What if the world governments sell 10% of their gold? That's a whole year's worth of mining. So that's how that flies around. What if people buy less jewelry this year? What if computers stop using gold and use something else for the chips or whatever they do? These are ways that gold changes supply-demand-wise. Okay, and it's pretty significant on a yearly basis. But over history, no. Historically, no. You still have a finite amount of gold while the money supply keeps growing. All right, so therefore, very simply, gold will go up over time. And the more they devalue money, every time you hear them say, we're going to lower rates here, and we're going to give out money here, and we're going to cut this percentage here, every time you see them doing something with money like that, that's better for gold. And it doesn't mean that it's going to happen tomorrow, but it just means that over the long haul, your gold is getting more valuable than the cash. All right, so I do like gold. Over the next 3 to 6 months, anytime gold's around 1,100, I'm happy to buy it. All right. Now, I'm sorry, you have to excuse me for just a couple of minutes. Okay, I'll be right back. Sorry about that. Like I said, I'm sick. All right, where are we? Gold, right. Silver. I have the same opinion on silver, except silver isn't going to go up the way gold will go up over time, but silver, I think at 1450 makes a good bottom. What was I going to say? Oh, money supply. Here's the other thing you need to be aware of. See, everybody's like baffled. How come we can do all this quantitative easing? How come we can put all this extra money in the economy and we're not getting inflation? It's because here's the money supply, which is on this side. No, I'm sorry, it's on this side. The money supply went up from like, what's that, maybe 800, about 800, whatever the hell it is, $billion to $2.6 trillion. Okay, that's, I don't know, I can't do math right now, 1.8, so it's like 200% higher. They tripled the amount of money in circulation, tripled. I don't know why this says 115%, because it looks to me like you go from, what did I say, 800 to 2,600 is 16 more, isn't it? 800 minus that is 18. Yeah, 18 more than 8 is not 115%. So I don't know what kind of drugs these guys are on. But anyway, so this is a 200% increase in the supply of money since the financial crisis. 200% money stock. Okay? But what's happened, though, and this has been happening for ages, and this is why we ended up in a crisis anyway, the velocity of money, the turnaround of money in the economy has been steadily declining, and is still declining, and is still declining. Now, what's the velocity of money? Well, the Fed prints a dollar. Let's call that a given. Okay, the Fed somehow prints a dollar. Whatever they do to make a dollar is made. That dollar is then handed into the economy. So what happens if you hand it to a worker? A worker takes that money and he buys stuff. Okay? He goes in his community. Usually, this is the old model. Okay? So Wally the worker takes his dollar and he goes to the local hardware store and he buys a hammer. And the hardware guy then goes to his hammer supplier. He takes that dollar now and he goes to his hammer supply guy and he buys a hammer from the hammer supply guy. And the hammer supply guy buys, who makes the hammer, maybe he's not the manufacturer, but he goes to the manufacturer and he gives the dollar to the manufacturer. So this dollar is turning over and turning over and turning over, right? If the worker takes a dollar and he brings it to his local restaurant, part of the dollar goes in the waitress's pocket, part of the dollar goes into the restaurant owner, then it goes to the food suppliers, and so on and so forth, right? So when a worker gets a dollar, that dollar moves all over the place. There's an incredible turnover when you give workers dollars. It's because they need it, and they spend it. They're turning it over constantly. And because these people are on the bottom rung, the bottom 50% kind of people, when you enrich the bottom people in society, the only way the money has to go is up. It's always going to go up. It's, you're taking your dollar and you're giving it to somebody who makes something else, and that person gives it something who makes something, and that person gives it something who makes something, and ultimately it ends up in a bank. But that's where it stops. And the bank keeps it, and they might lend out that dollar, but they always want the dollar back. The bank's not like spending the dollar. They're not even giving it to their own employees, basically. They don't even give it to the tellers. They just keep the money. So, in the old days, money used to have a great turnover ratio. Whenever you put money in people's pockets, it would get multiplied through the economy. And you know what's funny? The rich people would get it anyway, but they just have to wait their turn. Now, since Reagan, we've had the steady deterioration of the velocity of money because more and more money gets funneled up to the rich people. And rich people, now look, if you give me $1, and a lot of you guys do give me $1, you give me $1 and there is only a 50% chance I'm going to spend it. Okay? You give $1 to The cleaning girls who just came and cleaned my house, I gave them $100 today. They're going to spend all of them. I guarantee you none of those dollars go in a bank. They're all going to get spent, and they're all going to get put back to use in the community and so on and so forth. But you give me $100, and I will, unless I happen to need some money that day, it's probably going to go right in my bank and die. I'll use it to create more dollars, but in a lot of ways it's passive. Like I'm selling option contracts. My dollar's not going into circulation. In fact, if I buy stock, my dollars aren't going into circulation either, are they? Because the money already went to the company when they IPO'd. All this new money doesn't go to the company. It's just money being traded back and forth by rich guys who trade their shares. The actual money does nothing for the economy. It just really means of keeping score. Like I take some money out of my scoreboard and I put it on your scoreboard, and you give me some shares and put it in my scoreboard, and then my scoreboard, then I get more, my shares appreciate, now I convert it to money, and then I convert it back to shares. It's all bullshit by that point. And it's not helping anybody. The only time it helps is when I finally cash it, and again, only the portion when I cash it, if I happen to do something with that money, it goes. Otherwise, it's just more cash that I stick on my balance sheet. And the richer you are, the more of a percentage your balance sheet is compared to what you spend. All right? Donald Trump, nobody believes him. Well, some people believe him. But Donald Trump goes around saying, I got $10 billion, okay? Fine. Maybe he does, maybe he doesn't. Who cares? Guy with $10 billion. How much money can you spend if you have $10 billion? Like, have you ever tried to spend $1 million? I'm talking about just freaking go out and go nuts and try to spend $1 million. I mean, not talking about like getting a yacht, but I mean just go out and just try to eat dinners all over the place and go to shows and buy clothes and do anything normal people do without buying something ridiculously expensive as an item. What you get is bullshit, because if you think about it, a painter painted a painting 100 years ago and somebody pays $30 million for it, who's benefiting? It's not the painter. Freaking Van Gogh sold one painting his entire life. So, it doesn't benefit anybody except for the other rich people who are trading shit back and forth. And they're not benefiting, so that does nothing for society, these kind of transactions. That's why the velocity of money is going down and down and down and down. Because what are the Fed policies now? What are they doing with this money? They're handing it to bankers. They're giving it to bankers, and they're giving low-interest loans to people like us who don't need it. All right, people in the top 1%, where I don't need a 3% loan. I can get a 3% loan, but I don't need a 3% loan. I'm happy to pay 4%, 4.5%, whatever. I don't care. It's really not important to me whether I pay 3% or not. The thing is, but on the other hand, it's good. It saves me 1.5%. You know what I do with that 1.5%? I put it in the bank. It's more profit. And that's what companies do. Apple's got hundreds of billions of dollars. So they borrow money. They don't spend money. They borrow money. They say, well, if I can borrow it for 3%, why would I spend the money I have? That's even worse. That's even less money going to circulation. They leave the money that they do have in the bank because it's cheaper to borrow the money, which takes more money out of circulation and ties it up. So this is the idiocy that is currently going on in QE, and this is what's going on all over the world. If you make policies that hand money to rich people, then the velocity of the money dies, and it doesn't turn over. That's a negative. You see this number here is negative. Well, that's not, I'm sorry, this side, the other side. But this is half, 50% drop in the velocity of money. 50% in 30 years. And we're going to go another 50% down if we keep going. But we can't. We keep going 50% down, we're going to basically break this country. We're breaking this country now. Excuse me. All right, so that's why I like gold and silver, though, because eventually, and it's starting to come now, eventually you got to give some money to the workers. And when you start giving the money to the workers, this velocity ticks up very quickly, and that makes all the money moves around a lot faster, and that drives up gold and silver, and it extends all these other numbers. So that's why I like those. Long term. Don't know when, but the more you see, all these minimum wage things are going to start kicking in, that's all good for gold and silver. Anything that puts more money into circulation is good for gold and silver. You'll finally start seeing inflation. And as soon as you start seeing inflation, gold and silver gets real valuable. Is the government still supposed to close tomorrow? The Senate almost unanimously, with 17 psychopaths abstaining, passed a bill to fund the government for another till December, basically. Of course, there were 17 Republicans that opposed it, regardless, because they didn't oppose anything. Now it has to go to the House, though, where the Republicans have firm control, and it's kind of top of it. And the worst thing is, because of the process, it's only going to hit the House like tomorrow night, so we won't even know until like midnight tomorrow whether or not the government's being shut down or not. I would like to say not, because they're not that crazy, but you know what? I'm flashing back now to that time when we did the TARP. And the first time we tried to put TARP through, it was the same thing. The Senate unanimously passed this proposal to do TARP, and this was before the big crash. This is while we were in a crash, but before it completely fell. I mean, we already fell off a cliff, but we were down like 30% maybe in the market. They run this TARP proposal, and the freaking Republicans voted down. It was like everybody was dumbfounded. I didn't think Boehner knew it was going to get voted down like that. I think he thought he had the votes, or he said he thought he had the votes until they went into the meeting. Then he came out with like nowhere near enough votes. And they voted it down. I'll never forget, we were sitting here that afternoon, and they voted it down in the afternoon, and the market dropped like 900 points right away. Because it was insane. And by the way, that's 900 points when the Dow was at like 8,000. So, I think it was like, so it's really about 10% in one day. We went 10% down because it was insane. It was completely irrational. How could you not pass the bailout program? You know why? Because it didn't give tax breaks to the wealthy at the time. So they turned it down. I mean, they passed it a few weeks later, but that was like another 2,000 points down on the Dow by that time. It was like 15-20% down before they finally passed the TARP. So I wouldn't want to take bets on how idiotic the Republican Party is. That's basically what you're betting on, is the rationality of the Republican Congress. That's a dangerous bet. Craig says, if this is a prop, what is a good trade when it's done tomorrow and after and take advantage of drop after? Well, we have our SQQQs, and we're going to have to add that play. I think either the NASDAQ or the S&P are my two favorite shorts because they're down less than the others, basically. If you look at the big chart, where's my big chart? Here it is. All right, so you look at the big chart, and who's down the least? Well, again, forget the Dow, because I talked about that this morning. Nike is holding up the Dow, so that's not it. The NASDAQ obviously can go another. It was down at this 10% line. Now it's up around 15%, so basically it's got a 5% drop to go. Everybody else is pretty much there, so that's why my favorite short right now is still the NASDAQ. Plus, as I mentioned this morning, there are still other companies that are holding it up that are ridiculous. Like you have ridiculous valuations on Tesla, on Netflix, on Amazon. I mean, these are companies that could go down 20% and they'd still be expensive. All right, so that's something you definitely want to consider. And, I'm sorry, excuse me again for a minute. Okay, I'll be right back. Okay, where were we? Oh, yeah, so the NASDAQ is my favorite short, right? Oh, excuse me. Lost sound. Did you really lose sound, or is it because I got up? Anyway. Can you hear me now, anybody? Hello? Thanks, Jim. Yeah, my stomach's just really bad, that's all. So, so it's hard for me to sit here and talk. All right, what was I going to say? All right, let's see, where are we? Silver, somebody else, Stanley said, I don't see how the market could stay up into next year with the world economy. How long can we stay up for? All right, well, look, America's getting better, and if wages start climbing, the economy is going to get fixed very quickly. That's the whole key. Unfortunately, though, the world is currently controlled by conservatives who are doing everything they can to stop wages from rising. We're in an anti-worker environment. We have been for many years. They're fighting tooth and nail to stop what needs to be done. And what needs to be done is real stimulus. Do projects that put people to work. We've got huge infrastructure problems that need to be addressed that we could put millions of people to work if we wanted to on stuff we have to fix anyway. And everybody makes fun of Keynes, or not everybody, but conservative jackasses make fun of Keynes, and they basically try to paint it like, oh, you want to give money away, put money for stupid things. That's not what Keynes ever said. Keynes says, hey, look, if you're in a recession and you want to get out of a recession, and you're the government, what do? You say, well, let's look ahead. Okay? Do we have any projects that need to be done in the next 5 years? Okay? And so we're in a recession now. And we've got a bridge that we plan to build 2 years from now. Let's build the bridge now. Build the bridge when you're having the recession. First of all, the raw materials are cheap. Could you imagine? I mean, look at the cost of steel and stuff. They're not going to do, this is the stupidest thing governments do, and Keynes is totally right about it. Governments are idiotic because what they do is when there's good times and prosperity, they build bridges which further create demands on commodities and things like that, and workers, and increase labor costs, and they create the bubble that's going to eventually collapse on them. The government needs to be contrary to the economy. When the economy is booming, the government needs to lay off workers. When the economy is down, the government needs to hire people. When the economy is booming, the government needs to put off spending money and put it away, not redistribute it to the rich. They need to put the money away for a rainy day, and when the rainy day comes, they say, oh, now's a good time to build a bridge. You say, well, copper's down 50%, steel's down 70% from where it was. This is a fantastic time to build 2 more bridges to go to New York to alleviate the traffic problems. And do you know how much benefit you get for how many years? It's been 100. The Lincoln Tunnel is falling apart. The Holland Tunnel is falling apart in New York. There are 2 tunnels that are falling apart that millions of people use every day. If one of them goes, and we proved this in 9/11, if one of these tunnels shuts down, and in the hurricane too, we proved it again. We proved it in 9/11, proved it in the hurricane. If one of these tunnels shuts down, New York is screwed, completely screwed. Just one tunnel goes down. So we were supposed to build a tunnel, and Christie screwed that up. I won't get into that. That's a big story. But conceptually, why don't we just build another tunnel, build another bridge? You have to do it eventually. You can't say, oh, this 100-year-old tunnel is fine. It's not fine at all. It's falling apart. We're spending more money. We spend more money every year fixing the Lincoln Tunnel than it would cost if we financed the building of a new tunnel. In other words, let's say the tunnel is $10 billion to build a new one, right? Every year we're spending $500 million plus to fix the old tunnel. If you take a 20-year loan at $500 million, you'll pay off the fixing of the new tunnel. So you float $10 billion worth of bonds at the ridiculously low interest rates we have now. You pay them back at $500 million a year, and you have a brand new tunnel instead of fixing the old one every day. How complicated is this? And that new tunnel will last 100 years. And not only that, though, but until the old tunnel does fall apart, you'll have an extra tunnel. I mean, it's a win-win-win-win everywhere you look, except for one thing, except that money, that $20 billion, instead of going to pay off all the workers and all the low-level people and all the construction guys and all the people all over the world who benefit from this stuff, instead of paying off all the actual workers in the economy, that $20 billion should go to one military contractor to build, that $10 billion go to one contractor to give us a few planes. Or Donald Trump can get a tax break on his inheritance tax and doesn't have to pay $5 billion when he dies. That's what the $20 billion, that's what the $10 billion is for to the rich people. So these guys are fighting tooth and nail to have us not spend money on infrastructure because that's money that they could somehow wipe out from the tax rolls and keep. So it does nothing. So it sits in their banks. That's the economy that we're in. That has to change. It really, really, really has to change. Otherwise we're not recovering ever. All right. Chow says, new Thinkorswim, all small charts that Phil has set up on a page have no current prices showing anybody solve this issue. Really? What do you mean no prices? Here's prices, 1878 and 1127. I mean, there are prices. It's just totally annoying layout, really. Or maybe you can't see it on my screen. Is that possible? Maybe it's on my screen with the colors. I don't know. See, I'll have to watch the replay and figure it out, but I don't know what to do about it. It's terrible. ES is back to 18. Do I like the short at 1880? Well, if 1880 fails, I like the short, but you got to be nimble on these things. You know, you can't just, the knee jerk is to short it because that's your statistically that's your play until it breaks. So yeah, it was another good short at 1880. These guys are short at 4100. These guys are short at 15950. Better short at 16, of course. And the Russell I wouldn't touch because it's too kooky right now. But up at 1190, of course, the Russell's are short. You know, and again, only because of the window dressing into the end of the quarter, I'm expecting, something to go on here. All right. Okay. Jim says we need a constitutional convention and get term limits. I honestly think it's too late. I don't have a lot of hope. What we really need is we need to make either Bernie or me should be dictator. I think I should be dictator first, and Bernie can have it after him. Give me a month. I need a month. And basically, I will chop everyone's head off. I just need complete control of this country for 1 month. I will just chop every single congressperson's head off. I don't care who they are. If they were in Congress, they blew it. They did not do their jobs. And we'll start from scratch. And the next group will have to be conscripts because nobody's going to want the job after I chop everyone's head off. And then we'll get people who actually know what they're doing, and start a new thing. We need a different kind of voting process. It has nothing to do with money. I think basically that the vote should be kind of, I think it should be somehow local. I mean, we really should have a local democracy in those, we should elect everybody locally in a local election, so that you're only voting, so you only vote for people in your town. Then the people in your town, I say town, my town's only 10,000 people. I know, so we know everyone in our town, or everybody who thinks they're good enough to run it. We know all those people. So you vote for people you actually know. You know their character, you know who they are and what they do, and so on and so forth. You only vote for those people. Then those people, in turn, vote for the next level up. They'll vote, so my town guys will vote for the state people out of their group. And then the state people will vote for the national people. So you just keep electing delegates up the ladder instead of the way it works now, which is God knows how. That will take money out of politics, and it'll allow us to basically start off with people who actually we know and who we trust and who we think can actually do this job. And then we can have a Congress that's made. And by the way, it's another thing. Congress can be made up of, my town's probably a good size for it is 10, 20,000 people. Every 10 or 20,000 people, which is generally what a district is anyway, every 10 or 20,000 people should get a congressman. I don't care how many congressmen you have in the thing. Instead of having 500 people, because you only fit 500 people in Congress because there's only 500 seats, they screw that. We have the internet now. Okay, so whatever the number is, 10,000. What do we have? 300 million people. So we have 300 million people. So it's not that many more. It's 300 million people divided by 10,000 people each. 30,000. Have 30,000 Congress people. That's what Congress should be. 30,000 people vote on shit. Okay, all the local people have a say in what goes on in Congress. Then you're representing the country. You know, as I said, those 30,000 could maybe you could go down to 3,000 or something like that if you want to do it on a lower level. But realistically, I would love it if 30,000 people, there's no reason 30,000 people can't vote. 30,000 people can get a copy of a report in 2 seconds. 30,000 people can read their reports. 30,000 people can go to the people in their community and say, what's your opinion on this important national issue? How do you want me to vote? What are we doing? That's how you can decide elections. The technology we have is not being used. I mean, frankly, you don't even have to do that. You need to go straight to the people and do everything by referendum. Okay, every morning you go to facebook.gov and you go click if you like something. It's like, do you like this idea? Sure. Why not? Do it. And you get enough votes and it's done. Although that's a little too popular because then you end up with money in politics again. But anyway, so something else needs to be done. That's what I would say. You start from scratch. You know, trying to mend the current system is a waste of time. Craig says, when you say they are propping up the markets for the quarter, how do they do that? How do they do that? Well, first of all, you buy the headliners. You know, that's in fact, I was saying that was it the NASDAQ? I think I was pointing that out on one of these charts, or on the S&P. Where's the one I was pointing this out on? I don't have much long. I don't have long. I'll tell you that, guys, right now. It's getting to the end of my ability to stay up. Here, NASDAQ. You see how the NASDAQ, unlike every other index, here's large traders have gotten out of the Russell. Large traders, the red line, have gotten out of the Dow Jones. Large traders, well, you can't see it there, but large traders, well, here's the S&P. Large traders, for the most part, have gotten out of the S&P, or less in the S&P than the commercials and whatever. But, you know, and they're really just propping up a bit the S&P and certainly the NASDAQ. What happened to it now? Oh, there it is. And absolutely the NASDAQ is being propped up by large institutional investors. They're propping up there's only 500 S&P stocks, there's only 100 NASDAQ stocks. They only have to prop up those stocks to make everybody, and 30 Dow stocks. They only have to prop up those stocks to make you think everything is fine, even though the other 8,500 stocks are doing terribly. And I pointed that out yesterday. I'm not going to keep going to screens because I'm getting exhausted. So, you know, I pointed this out in yesterday's post. The percentage of stocks that are at the year low compared to the numbers of the year high, there's only like 20% of the stocks that are something like 80% of the stocks are near their 52-week lows. 52-week. 20% are not. But from the indexes, you would never know it because the indexes look good. And why do they look good? Because you only have to prop up a few stocks to make the entire index look good. As long as you keep Apple up, the whole NASDAQ looks good. And Apple's having some trouble today, but generally, if you keep Apple up, the whole NASDAQ stays up. That's all you have to do is control this one stock to keep the NASDAQ going. And if Apple fails like it is today, where is it? Apple's having a tough time today, back at 110, but you can get over that by pushing up something like Netflix or something like Amazon or whatever, or keeping them up. You know, there's all these different key stocks that control indexes. Every index has a few key stocks that really control it, and it's not by accident. They make it that way. They design it that way because then they only have to push 3 buttons to move the whole index. And while you've got those 3 buttons pushed, you can sell. If you have 100 stocks and you push 3 buttons and make 3 stocks go up, you can sell the other 97. You know who you sell to? Everybody who's got a 401k, everybody who's got an IRA, they're forced to buy the stocks because they trade the ETFs. And when they trade the ETFs and they're constantly putting a certain percentage of their retirement money into the portfolio every week from their paychecks, they're basically forced to buy all these bullshit stocks that are getting dumped because the whole index is being held up. So in other words, you put 3 stocks in the NASDAQ up and you let the other 97 drop. Okay, so the big guys are selling 97 stocks. They're propping up 3 of them. And they keep selling the 97 to all these index funds that have to come in because the NASDAQ, the entire NASDAQ is high, the QQQ or whatever, is high because 3 stocks are high. So that makes the whole QQQ high, and therefore the money comes in and they keep buying your shit 97 stocks for full price. Until the big guys have dumped all of their 97 stocks, then they're left with those 3 stocks, and then they just buy puts on the 3 stocks and let them drop out the window. And that's why at the end of a rally, at the end of a set, in other words, when the market starts collapsing, which you saw in 2008, in 2008, when the market started falling apart, Apple was still doing good for a while, because even then it was a big part of the NASDAQ, and it was doing okay. Then all of a sudden, boom, it fell off a cliff. And it fell off a cliff because they were done propping up the NASDAQ, and they let it go. And as soon as they let it go, it dropped like a rock. That's all there is to it. That's the difference between you and a hedge fund and these big fund guys who manage billions and millions of dollars, is they are always hedging, and they are always using puts and short positions and short futures contracts, so they make a fortune when the market goes down. And the best part of that is they are the ones that control when the market goes down, so they make a bigger fortune than we do even when we play it, because they know the day that they're going to cut it. So they'll stock up, and they buy all their puts when the VIX is low, and they get good prices, and then they drop the thing like a rock, the VIX shoots up, they start selling their puts, and they start buying the stuff that they just sold at lower prices. And that's why you see people like Goldman Sachs and JP Morgan, they've got 100 consecutive days without a loss when they report their quarters. Like, yeah, we had 100 trading days with no losses. It's like, what? In this market? But they do it because they control it. It's not a real market. Could you imagine guys spinning a roulette wheel and telling you had 100 spins without a loss? Or even flipping a card or flipping a coin and saying, I did 100 times, no losses. Never lost. You could be really, really good at it, you're still not going to go 100 times. Just not. It's just not possible. Statistically, I think somebody did it. Somebody ran the odds on JP Morgan's success rate, and they said it was like billions to one. They said there's more chance of life on Earth. It's like finding life on a planet. There's more chance of that than there's a JP Morgan's trading record being legitimate. And it's only because they control the markets. It's manipulated. Everything's manipulated. It's a big game. We make money because we know it's manipulated and we don't care. We follow the manipulations. Nobody's trying to outguess the market here. We're just basically making money off the manipulation. Where was that one? Okay, we gotta wrap up. Covering up the markets. What you really need to do is, but it's too late. They're elected. They're in power. You have to get these people out of power. And look, Jefferson said you need to have a revolution on a regular basis. He said you can't run a democracy. He said a democracy can't age. You have to refresh a democracy with revolution on a regular basis. He expected his government to be overthrown. Because he said, you know what, we're going to get old and be jackasses too. And younger people have to come along and say, we want to do it completely differently. And if you don't do that on a regular basis, you get the same crap that they left. He saw that. He was a smart guy. All right, where are we? Farn said you can go back to the old style. That is not correct. You cannot go back to the old style. Believe me, it's the first thing I tried. You cannot go back to the old style. It says something about being old style, but this is the style I have now is old style. I have to run for office. I will only run if I can be dictator. I would have to be elected dictator. I'd have to have 100% authority and license to kill. I seriously couldn't stand it. I could not put up with that crap for like a day. I would go crazy. I'd be the first senator to come in with a gun and start shooting people. Yeah, the Constitution started out with good intentions. It just kind of fell apart, unfortunately. What is this? What is going on here? That's the way the Senate's supposed to be. Your state reps elect the senators. James Coe says, oh, please. Oh, come on, guys. Really? All right. Anyway, guys. All right. So all politics aside, yes, I am a bleeding heart liberal. I'm proud of it. I'm not one of those shamed liberals. I'm a proud liberal. I think it's a good idea. We used to be called progressives, but now we're called liberals, and I frankly don't really care what you call us. But the idea is to sort of be nice to people. Socialism. I know socialism they turned socialism into such a bad word. It's so funny because it doesn't mean you're not a democracy. It just means that you care about people. It means that you think people are more important than corporations. I mean, I guess there's a certain amount of people who disagree with that, but that's the problem. It's not that people in this country, if you ask them their questions the right way, it's not that they disagree. Most Republicans don't think corporations are more important than people. They just think that socialism is evil. And therefore, it must be bad, even though it's not. Even though it's just socialism has nothing to do with being not a democracy. You democratically decide who you're going to help and how much you're going to help them. You do things with a society-first mindset. You put the needs of society ahead of the needs of the individuals. That's what socialism is. If it wasn't for socialism, we would never have advanced as a species. Okay, our whole thing as mankind is that we're social animals, that we do things as a group, and that we form specialties within a group, and we move forward as a group with group leaders telling us what to do in productive ways. That's how we go as a society. Unfortunately, capitalism is not, and again, capitalism didn't used to be a bad word, and it's maybe still not technically a bad word, but it is to a lot of people these days. But capitalism used to be, it just meant that the leader would, or that you let the profits dictate, the profit maximization dictate your decisions. So you run things for the benefit of creating capital. That sounds good in theory, but when they came up with capitalism, nobody really envisioned capitalism as a concept came around, got popular in the 1800s after we overthrew all the monarchs. And then things were very socialized for a while because we redistributed all the wealth and so on and so forth. We overthrew the monarchs, and the money was evenly distributed, and then people said, well, let's let the capital dictate where it needs to go. That made sense at the time. But nobody thought that we'd have a new monarchy, which was basically the top dog capitalists became the new monarchs. And now that's what we have. We have a new monarchy of people who are just so freaking rich, like Carl Icahn or Donald Trump or whatever, that are so rich that they have, they're essentially as rich, the expression here is rich as a king. They're as rich as kings. They make rules like kings. If they want a law passed, Donald Trump said this. He goes, if I want a law passed, I whip out my checkbook and I get a law passed. That's how it works. He said that. The only thing he wouldn't say is, who did you buy? They asked him, who did you buy? He said, I'm not going to tell you. But that's what it is. And I'll tell you, and I won't tell you who I bought, but I will tell you that same bullshit in New Jersey politics. If you want to get a law passed, you go have dinner for $500 a plate and bring 10 of your friends. That's how you get a law on the books. You go to somebody's fundraiser with 10 of your friends. You book a table. You give them a check for $5,000 at the fundraiser, and all of a sudden, the congressperson becomes interested in your legislation. It suddenly moves through committee. All of a sudden, magic. That's how laws get made. And if you do that favor for the right amount of people, you can get almost anything passed. What shocked me about politics when I used to run my business, it wasn't that you could bribe politicians. I mean, that's a well-known fact, right? It was how cheaply you can bribe them. That's what was shocking to me. How little money it really takes to actually bribe somebody. That just blew my mind. And when I started seeing the crap that was going on, I was mortified by the whole situation. And it's the same thing. It goes all the way up the ladder. You see it all the time. Everybody just accepts it like it's okay. Like it's okay that, we elect these people to represent us and they go ahead and screw us right and left all the time. That's got to change. So that's why I'm a liberal. It's got to change. And the Republicans aren't going to change it. They can talk anti-government all they want, but they are the government. They are the guys doing it. And not that the Democrats don't do it, they just don't do it as much. And the Democrats are willing to put Bernie Sanders in as a candidate. That's the difference. Bernie Sanders says, tear it all down, stop this stuff. The Republicans would never have a Bernie Sanders running this thing. They will never have a person like that say, this is all wrong and it has to stop. So therefore I'm a Democrat. Can't help it. I haven't got a choice. I wish there were more choices, but there's not. All right, so last couple of things I got to go. Do you think the markets will be pumped up to the end of the month? Well, the end of the month being tomorrow. I think they're trying, but it's not doing any good. This is my worst case scenario. This is what we were worried about, is that they're unable to prop up the markets, and that there's more people are trying to sell. Hang on, let me check the volume. I'll tell you in a second. SPY, no, see, the volume today is actually pretty light. 91 million, average volume 148 million. We've got, an hour to go? 2 hours to go. The volume is basically light at the moment, so they haven't done much. Tomorrow should be a much higher volume day, I would think. But yeah, I think they'll hold them up until the end of the month, but I think we might be in for a nasty shock in October. I think we could go down unless somebody does something pretty drastic. Apple under 110, that was to be expected. With LL down 9 days in a row, can you update your trade? Oh God. I don't know what trade you mean. Lumber liquidators. They're not down for a reason. They're just going down with the market. It's just stupid. What are they at, 13? I mean, I'm not sure what the trade is. How about telling me what the trade is instead of forcing me to find it? All right, I have no idea what trade you mean, Alan, so I'm sorry. But if you can tell me what it is, I'll be very happy to talk about it. Let's see if we can pull a chart on these guys. So lumber liquidators is just, I mean, I don't understand, because if I made my trade, I made it here, wherever it is, my target is still up here. Let's see what this thing says about them. I don't think there's been any news. I haven't seen any news in ages on them. Lumber liquidators still in a state of flux. Okay, well that's cool. Upgraded lumber liquidators finds the floor. September. There's nothing. There's nothing happening. It's just the same nonsense. They're coming into earnings on October 20th. We'll see what they have to say. But I mean, you just got to give them. It's a long-term trade. The bottom line is they're going to take ages to turn around. So it's not a short-term trade. So if you're in a short-term trade, you want to go longer. That's for sure. But I think they're great long-term stocks. Okay, you're not saying anything, so I don't know where you are. All right, I don't know what the trade is, but whatever the trade is, I love a long-term position on these guys. I think they're ridiculously underpriced at the moment. If you look in 2017, they don't have 2000. We're waiting for 2018 to come out before we reposition anything. Look at this. The stock's at 13. You can sell the $13 puts for $4.89. You can sell the $10 puts for more than $2.70, because this is an old trade. You can sell the $8 puts. Put it this way: you can sell the $8 puts for $185 at least, because $185 is the very low end of this range. That's net 6. That's half price. So if you hate them that much, get out, because if you think that they're going to go lower than that, if you think they're going to be below $6, why would you even be in the stock when it's at 13? That's 100% above your target. I think they're going to be much higher. But so in other words, to me, I'll sell tons of these because it's net 6. And then I'll use that money to buy spreads. Let's see, they're at 13 now. So let's say we buy the 15s for $4, okay? $4 for the 15s, and we'll sell the 20s for $2.70. All right, so if I do this, here's what happens. I buy the $15 calls for $4. I sell the 20 calls for $2.70. No, screw that. Sell the 25 for $2. All right, that makes $2 on the spread. Now I have a $10 spread, 15 to 25. So you're buying the 15s for $4. You're selling the 25s for $2, and I'm selling these guys for $1.85, or I'll sell these for $2, or whatever it comes out to. I bet you can sell them for $2 at least. So you'll be in the spread for net 0 or net 10 cents, and anything above 15, you make money. And your worst case scenario is you own lumber liquidators for $8, which is $5 below the current price, like 30-something% off, 40% off. So do I not like that? How could I not like that? I don't think they're going to go bankrupt. Therefore, I love it. I think that's a fantastic trade. And if you have a trade at a higher strike, you can roll down to a similar trade. But again, I'm kind of waiting for the 2018s to get out before we do anything else. And we're not in a hurry, obviously, because the thing's not, it hasn't been doing anything. All right, so I guess I answered your question. If I start a new position, yeah, that would be my new position. Okay, guys, I feel good about getting through this. Holy cow! Oh, I gotta lay down. Meanwhile, we're having a nothing day. We're flatlining all over the place. We're barely holding 1080 here. I'm not happy about that because we got a little bit. We got more bullish on the Nasdaq, and it's just not doing it. We're not holding 4 4080. We're not holding 1080. We're barely hanging on here. It's not good. So this is not pretty. How's silver doing? Silver's up at 60. So silver topped out. Oh, look at that. Oh, man. Silver went all the way up to 1470. Damn it. I got out too early. I got out when it stopped out here, and I didn't get back in because I was busy. It came up, and it came up past 65 and past 60, and then it came down, and then it stopped and went back over. Anyway, I don't have time to sit there and do this stuff all day. That's why. So where were we? So that's it. Okay, we'll do. I promise we'll do more as far as calling stuff next week. But that's what we did for now. Oh, I do want to talk about one thing. What did we do today? I forgot. We did a trade today, didn't we? That wasn't it. Well, that was our original SQ2 trade. You can probably still do this one because now wait a minute. No. So with 23.27, let's see what that looks like now. It's a good hedge. It's a really, really good hedge. Oh, in fact, with Apple, you can definitely do it now. So SQQ, I don't want to go October anymore, though, because October is too soon. Let's say November. This is a hedge, don't forget. So we're at 27 now. So if you think the Nasdaq's going to go lower, you can start at 25, which is 420. All right, so take 420 there. Then we go to the 30s, let's say, and those are 288. Wow, but it wouldn't be. These prices off. Oh, how about the 29s for $3? Well, I like that. So what I say? Okay, 25 are 422, and these guys are $3. The 29. So it's a 25-29 bull call spread is only $1.22. It's in the money. You cannot lose unless the Nasdaq goes up. So if you're trying to protect your long positions and you're worried about them getting further hurt, this position can't possibly lose unless the Nasdaq does go up. Then against that, you can now sell. You go over to Apple, and you find something you can live with. What price do you wish to pay for Apple in January? All right. How much are you willing to own Apple for? What's the most you can swallow? So if you're willing to own Apple for $100, you get $4.60 a share. A contract. If you're willing to own Apple for $90, this more than pays. This pays for this. It's $1.22 for that spread. It's $2.40 to sell the 90s now. So for every one Apple 90 contract you sell, you can buy 4 of those spreads, which are worth $4 each. So you get $16 of protection for every one Apple contract you're willing to sell. Not $1,600, sorry. So $1,600 of upside protection for every one contract of Apple that you commit to. So for every 100 shares of Apple you're willing to buy for $90, you can then get $1,600 of downside protection on the S&P. That's the way it works. So if you do like a 4-to-1 spread, so if you do 5 of these, promise to buy 500 shares of Apple, you'll collect about $1,000-something. Then you do 20 of those contracts, which will be $1.22, so that'll be like $2,400, less the $1,000 you collect here. So for about $1,000, you'll have 20 of those contracts that pay $8,000. That's back to kind of what the original spread was that we did, except with a little bit better strikes on the short Apple side. All right, so that wasn't even the one I want to talk to you about, but since I was looking, that's what I wanted to say. There's all fun stuff we do. See, we have Paul McCartney and Wings. We have a beautiful picture of downtown Cleveland. This is what a day is like at PSW. All right, Micron, that's what I want to talk about. This is a really good spread. Micron's at 14. You're buying the January $14 calls. You're selling the October. They're coming to earnings. You're selling the 50 and 50 calls. Those are way out of the money, and you're getting 50 cents for them. That knocks the price of your 14 calls down to 150. We're offsetting that price by selling the 13. These shouldn't be calls. These should be puts. We're selling the $13 puts for $1.17. So we have a very low-cost trade. It's net $865, and the spread is a $1,500 potential. So you can almost double your money on this spread. So I really like this one. Okay, this one just went into the option opportunity portfolio. We were going to take 20 of the January 25-30 bull call spreads in the option opportunity portfolio to cover our 10 short calls. I'm thinking probably what we're going to do after the seminar is we're going to take 10 of them just in case. I'm kind of wishy-washy on it. If I'm wishy-washy, why don't we take 10 and see what happens? So we're going to pick up the 25 calls in January, and we're going to sell the $30 calls. So just so we're a little bit more covered on the shorts in case the NASDAQ does collapse tomorrow. I don't think it will. I hope it doesn't, but if it does, I'd like to be covered. And I guess that was all. I guess that was our last play. All right, now I really have to lay down and start my field again. All right, guys. Thank you so much for coming. Thanks for putting up with me, even though I'm sick. I appreciate it. And hopefully we'll do a more fuller one with more stuff next one. RRD, worth a look. They're breaking up. It's confusing. You really have to think about that before they get off, okay? All right, take care, guys. Have a really good week, okay? Thanks.